Technology has dominated most of the year, and despite a recent pullback, it is still a sector to watch, and this ETF may be a great way to gain some income and exposure at the same time. Fasten your seatbelts, folks. This is going to be a good one. The Evolved NASDAQ Technology Enhanced Yield ETF has a ticker of QQQY on the TSX, and it has been a superstar since its launch roughly 11 months ago. This ETF debuted at just the right time to take advantage of tech's stellar year, and they are positioned to do well as tech catches its second wind. This ETF holds a basket of 41 technology companies listed on the NASDAQ 100, and then they utilize a covered call strategy to pump up the returns. They do write covered calls on up to 50% of the portfolio. I will point out that this is on the higher side, so when it comes to capping growth potential, there is a greater chance of that happening with this ETF. We will find out just how much of a factor that has been when we compare it to the benchmark NASDAQ 100. We will be doing that in just a wee bit. Speaking of growth, clicking on the sub button is a great way to uncap the channel's potential. This is an ETF that is very much tied to the tech sector, and when evaluating its future performance, you do have to look at the sector in general and how it is expected to perform. Tech had a great start to 2024 as the NASDAQ rose from 16,667 all the way up to 20,690 on July 24th. Since then, it has fallen down 6.51% to 19,343. Nonetheless, the year still looks very good, with tech being up 16.05%. That is going to be the number QQQY needs to beat. There are naysayers out there who will preach that tech is done. The AI bubble has burst. I do not subscribe to that. And in fact, despite the retracement, there is still something hugely bullish going on in the charts. Every low the NASDAQ has made in 2024 is higher than the previous low. That is a bullish trend, and it speaks of more upside potential. In regard to the AI bubble breaking, OpenAI just revealed their newest model, which is a huge step up and a clear sign that the AI slowdown is not as close as some investors fear. I do think tech will rebound before the end of the year, and I am still bullish on the sector overall. I do believe mid-November into December will be a strong tech finish for 2024. With all of that being said, we are here for QQQY, so we should jump into the data. With numbers ready to drop, we need to call on the one guy who always has the right angle, the one and only Mr. Math. We will start with a little surface data. At the time of recording, their current value comes in at $24.90. They have an NAV of $25.20. Their net assets, they come in at $52.48 million, and they've got a pretty stable beta of 0.48. So that's about half as volatile as the market average. Their price to earnings ratio, that's coming in at 34.81. Their average volume comes in at 21,190. These numbers are a good start, but we need to peel back a layer and take a look at the fund specifics. And I know many of you guys are always thinking about the fees. Well, the management fees on QQQY is 0.50%. When we look at that management expense ratio, that comes in higher, 0.72%. Sometimes that management expense ratio is not the end all when it comes to fees. So in total, when you add up all of the expenses, including their trading costs, the overall fee works out to roughly 1.30%. This is definitely high, but they are doing a lot, and the return could very well be worth it. Let's take a look at their holdings. So their top 5 holdings include Apple at 11.23%, Meta at 10.90%, Nvidia 10.5%, Broadcom 10.4%, and Microsoft 10%, right on the nose. Now, this is an ETF that does rebalance quarterly. So 4 times a year, they play with those numbers a little bit. Now that we have the inside on their data, I do think it's time that we need to check out those dividends and returns. Let's start with that dividend. They have a yield of 12.862%. That's a quarterly dividend of 32 cents per share. I will point out, They've only been trading for 11 months, but we did see their dividend increase from 21 cents up to 32 cents. So that's not too shabby at all. Okay, let's look at the actual returns. On the 1 year, the return on investment comes in at 23.94%. Factor in the dividends, we get a total return of 38.73%. Holy banana bread, that is really good for 11 months. On the year to date, the return on investment comes in at 8.54%. Add in those dividends, we get a total return of 19.66%. I am loving these returns. So let's take that return data and run it against, well, let's take a look at the benchmark. Seeing that QQQY is only 11 months old, we're going to look at the year-to-date data for our benchmark. So the NASDAQ, and I did mention this earlier, at the time of recording, their year-to-date was 16.05%. That's a great number. And it does not include any dividends that you may be receiving. So in comparison, we will look at QQQY's growth first. Well, they kind of fall short, 8.54%. So we are seeing the growth component falling short, which is that cap potential losses that I mentioned earlier. However, once we add in the dividends and we look at a total return of 19.66%, we do eke ahead of the NASDAQ. Now, you could argue that if we counted the dividends on the NASDAQ, it could win. Well, no. The average year-to-date dividends on the NASDAQ comes in low at roughly 1.49%. So that would mean a total return of about 17.54%. You got to remember, there are a lot of big tech companies that have very little or even no dividends at all. So that's why that average is pretty darn low on the NASDAQ. I think we have enough information now to ask that big question. What is my final verdict? When we talk total return, it does beat the benchmark, and that is great. If you were to reinvest the dividends back into QQQY, you could even take that to the next level. This is an ETF that I think a lot of investors can like. It has enough dividend juice to keep the income investors happy and enough total return to tickle the fancy of the growth and total return investors. This is goodness, for sure. However, we have only seen this ETF perform in better markets. The test to their performance in less than stellar markets is still to occur. I suspect that growth and total return investors may not stick around for stormier markets, but the income investors very well could, provided the ETF can keep pumping out the dividends. I would love to revisit this one on the other side of the next bear market for sure. Until that bear market, I do suspect this ETF will be very good, and I am not expecting a bear market for a while. So there is time for this one for sure. If you are interested in QQQY, don't forget to put in a whole heaping helping of due diligence before you place any of your hard-earned money on the table. Let's continue that learning journey by checking out this video on REIT ETFs. Thank you for watching, and I will see you in the next video.